My name is David Siddons, and welcome back to another episode of Better Decisions Podcast. Today, I'm sitting here with Paulo Rodriguez. Paulo, introduce yourself for the audience, and then we're going to get into it.
Sure, absolutely. So I'm a mortgage professional. I'm with CrossCountry Mortgage. I'm a senior vice president there. I've been in the mortgage industry since 2005 and rode out the crash. And today I really focus more than anything on the higher end, the mid to higher end client. That's really where my scope is.
And thank you. You got my attention initially because you were, one of the few who was sending out these reports every month, and you still do it. And I just actually the conversation is going to revolve around your last one that you put out in September. And we're going to expand on it for those who have already seen your report in September. This is just going to be like an extrapolation of that. You put these reports out and you talk about the numbers in the market, and you're very analytical and you're very articulate in the way that you, talk about the market. So it's really appreciated. And that's how you got onto my radar. And, I like to think that I'm a student of the numbers as well, spending a lot of time writing reports, doing articles. And this podcast is really going to ask the question that we probably get, and I know we do, we get asked every single day, and it can be summed up in one simple sentence. What is going on with the market?
Yeah, it's that is pretty much what I hit with the topic of the report that I just put out. Right? Should buyers stay put, and should sellers get out now while they still can?
So say that again. Just so process this, guys, because this is a good thing to really get into your head, because I know it's going to resonate.
Sure. Should buyers stay put, and should sellers get out while they still can?
Okay. Pretty alarming stuff if you think of it like that as a comment, but of course there's more to it than that.
Absolutely.
So what I would love you to do is kind of go into a little bit of each of the sectors that you cover, because I know you got a lot of data, and I asked you to text me. So where do you pull your data from? And if I remember right, it's like CoreLogic, NAR, Black Knight, Fannie, Freddie, Calculated Risks, Showtime. There's a whole bunch of sources of data that you're getting, which is great. Let's start through with like what you've been observing.
Sure, absolutely. So I think that we are in a war of information right now, and it's us versus the media. And I think that there's a conflict of interest with the media having to monetize what they do, because they're running a business at the end of the day, and they're competing for our eyeballs. And so they're taking data and then basically taking out of context. So let me give a very extreme example of that, right? If we go from one foreclosure last month to two foreclosures this month, we're up 100% in foreclosures. Mm-hmm. But is two foreclosures going to be relevant? Not really. So that's the kind of thing that goes on. So I like to pull from really the areas, the data suppliers that the media is not pulling from, right? It's the data that we have access to as insiders in the industry, that the person on the outside doesn't really have access to. And then I like to just put that in very layman's terms and just and put it on the market so people can understand what's going on.
Absolutely. And it's funny that you talk about what the media does, because there was an article that came out a few weeks ago, and it talked about how all these people are migrating out of South Florida, and they were going back to I'm laughing already. they're going back to New York. And then there was an article that came out like 2 days ago, and it's in New York, and it's in one of the New York papers, and it says, like, showing pictures of the number plates saying everyone's flooding out of New York and they're all going to South Florida. So who's telling the truth here?
Right. Exactly. And so, again, I think it's more truthful to say that there's more people coming from the Empire State to Florida than vice versa. But yes, there are people in South Florida that are getting priced out of the market because the purchasing power of well-off South Americans, well-off Northerners, people from California is outbidding the locally paid individual. And yes, some people are being priced out, and some people are having to migrate, but they, at this time, few and far between, right? It's the migration, the net migration into South Florida is positive. It's not negative by any means, not even close.
Yeah, one of the interesting bits of information that you put out that I saw in your September report was talking about how things have slowed down, but not stopped. And I say slowed down because we went from the sublime to the ridiculous between 2020 and 2022. And as you put out, it's not sustainable. That wasn't a sustainable, and that was a black swan event. That's actually a comment that I stole from Anna Bozovic. Thank you, Anna, for that one. That we were talking about how everything just erupted and all these people came down in thousands and thousands of numbers. Now, that's not a sustainable model. We know that. Trees don't grow to the sky. But that doesn't mean that everything is now reversed and gone back the other direction. It just feels more like that because it's slowed much more.
Yeah.
What are some of that data that you had? Can you kind of just, I guess, impress upon the audience some of that?
Sure. Let's see. There's a lot of it, right? So what comes to mind? Well, I mean, let me go back to something you said a moment ago. Yes, definitely things have slowed down, but that does not mean things are depreciating, right? So if we're going down the highway 120 miles an hour, we're not going 60, but we're not going backwards. So I think that is the important thing to understand. Sales velocity is definitely slowing down. So the number of transactions happening in a given time period is definitely down. What's causing that? Well, I think it's a ripple effect, right? With mortgage rates. Mortgage rates have a lot to do with that. Talk of a recession has a lot to do with that. People are staying put. You cannot ignore the very strong correlation between the stock market and the real estate market. And with the stock market doing a pullback, it's giving people more pause. Mm-hmm. So you're seeing a slowdown in velocity. You're seeing, here's something that I think you wanted to touch on. We're seeing a transition in a market where during the absolute mayhem and buyer desperation that we saw less than a year ago, where we saw that an asking price was the floor of a negotiation, an asking price has now become the ceiling.
Yeah, that's beautifully said. I love that comment that you made. That's really smart. It's really on point, actually. It's true.
Yeah. So, I think that buyers have more options. There is, because sales velocity is slowing down, there is more inventory, more options now, and buyers are in a better position to negotiate. But that does not imply depreciation. We still have a massive inventory problem on a nationwide basis, right? And I think you can speak better to South Florida specific, but I like to focus on my national audience. And we just have a problem. And it's manifesting as a result of multiple reasons. One, people that are in a mortgage that are at 3% interest rate don't want to move because they're going to have to take on a 6% mortgage right now, right? So they're looking at the cost of ownership, the change in cost of ownership, and it doesn't make a whole lot of sense. Builders are scared right now. They're not putting out as many units. There's material shortages. I have a client that is a spec builder, and he says, Paulo, I cannot get any cement right now.
We'll talk about builders later on, but I'm definitely going to put that into the conversation because I can give you some local information on that is relevant to South Florida. The slowdown, percentage slowdown, I think you had mentioned that the home appreciation by core logic was 3.8%. Was it something like that? Does that sound about right?
It sounds about right.
Yeah, I think that the growth of the appreciation, just to be clear, so in South Florida, in Miami, and I put this on previous podcasts, I think 2020 and 2021, we saw 25% and 28% increase in values for home values. I think the home values went up like 53%. Mm-hmm. Condo values went up 44%. That is a ridiculous amount. I mean, that's like a huge number. And then previous to that, we were around, I think, maybe 6 or 7%, and then 8 to 9%, I think, 2019. Now we've come down from basically 1/3 of what we were growing before. But if we look at inflation and we consider home appreciation at a far more sedentary level, and we're bringing it down to next year, I think the national rate was about 9%.
So you mean for this year?
For this year,
so with the appreciation, most of the appreciation having already happened at the beginning of the year, yes, it was somewhere between 9 and 11%, if I remember correctly.
Okay, and that's a national number.
That's a national number. Now, your 3.8 is correct. That's what the moderate appreciation that we're looking for 2023, 2024, which happens to be a historical average. If you look at the data going back decades, and you look at the appreciation, the average appreciation of the real estate market is 3.8% annually on a national basis.
Which when you were talking with your report, you're talking long term. And again, I think there's lots of different people out there who watch this and will relate, and they'll ask themselves, okay, what kind of buyer or seller are you? If you're a buyer, are you a long-term buyer? Because long-term, as you mentioned, you made a train wreck of a decision. Initially, what you thought was a train wreck of a decision by buying a property that then lost value because it went through the downside of the market. But fast forward 10 years, now it's obviously worth more than what you bought it for. Just like a lot of things, stocks, example, if you hold it long enough, it's going to come up the other side.
Exactly.
And again, single family is, and when we get into it, the conversation, homes and condos are very different animals. The condo,
especially in South Florida.
Especially in South Florida, condos, you can build a ton of them very quickly, or it feels that way. And there's new developments everywhere. Houses, house shortage, reality. It's hard to build a home. Yep. It's harder to build a home now than it ever was before. And my wife does this for a living, and she'll tell me, David, it's 3.5 years to build a good high-level custom home right now from what it was before. Spec, I'm sure you can do it for less, and it's probably 2.5 to 3. But, it's still a problem. There's not enough land. There's not enough labor. Materials are more expensive. All of these variables mean that it's hard, and new homes account for only 15% of our entire sales market. Right now, it might be even less than that. But when we go into the mortgage rates, and again, the mortgage rates play into the investor class, because I know there's primaries investors. What's the as a mortgage broker, take us through what the rates are looking like as they are moving forward now for the next,
Yeah, absolutely. There is, we're actually seeing better rates in the higher loan amounts, right? So in what we call the jumbo space. And the reason for that is really that banks are sitting on their cash, and they are willing to not give it away, but be cheap so that they can acquire a client. Whereas the lower end market, which is not really something you deal too much with, so I'm not going to dwell on that. But Fannie Mae and Freddie Mac, for example, at the time of this recording, are somewhere in the mid sixes. Right? And so that's your conventional rates. Now, when you start getting into some investor type products, some more exotic stuff, I'm seeing 8s and 9s. So
really,
yeah.
What do you mean by that? Define by that, just for like layman terms. So when you say jumbo, and you're talking that higher end where it's like 5 to 6. Yeah. Give me an example of what that looks like.
So. What do you mean? What
like
the loan
a
amount?
Product. Yeah, exactly. Yeah. What the loan amount is and how much they're borrowing.
Sure. So let's just use a $1 million loan amount, right? Maybe they're putting down 20%. 30-year fix, you could be somewhere in the mid to high 5s, and an ARM could be in the low 5s. That's what the jumbo client cookie cutter is looking like at the moment. Now, of course, that we got to get more granular and explain. Somebody with a very good private banking relationship at one of the larger well-known banks. Can possibly obtain a better execution than that. And the reason for that is simple. A private bank's primary concern is that you keep your brokerage account with them because that's how they're generating their fee income. They could care less about making money on your mortgage, so they're happy to give it away, right? Whereas, take a look at the other end of the spectrum, Fannie Mae, the business that Fannie Mae is in is of making and securitizing loans and making a gain on sale. So different business models. So that's part of the reason why jumbo rates are looking.
And 1 million is not, in this market, 1 million isn't even an entry level anymore.
Just
to the
using
market.
round numbers.
Yeah. I would use no working example again, given that I sell luxury real estate in South Florida and I'm dealing with the primary markets. And I'll touch on the numbers through the conversation. Coral Gables and Coconut Grove and Miami Beach and Key Biscayne and the high-end stuff that we're dealing out that might be in Brickell or South of Fifth or South Beach or Bal Harbour, Surfside and Sunny Isles. When we're getting in, are you seeing much in the way of borrowing in the 3 to 5 range, 5+ range? Because that was up until the last couple of years, a lot of my buyers coming in, they were just straight up cash. Yeah,
they're straight up cash. Now, they were probably taking a margin line against a stock account, right? Mm-hmm. And then figuring out what to do later about paying that back. And truthfully, the rates on those are better anyway. So if you have a brokerage account with sufficient cash to leverage and pay for a home in cash, it makes all the sense in the world. You're gonna get much less headache. It's a stroke of a pen, and you get your loan. Mm-hmm. You don't have to go through the 30-day mortgage process, and a bunch of lender fees as well. So it makes sense. It makes sense that was the case. At the moment, I'm not seeing that change too much. I still see a very, very high percentage of cash. Just about all of Dade County is north of 50% in cash. I don't know if you're seeing the same thing.
That's an interesting statistic. So north of 50% of the people buying in Dade County
of price points $1 million and above.
Yeah.
price points on a million above are north of 50%. There are some exaggerated cases where I looked at the data for just Miami Beach and I saw things north of 60%.
Doesn't surprise me, by the way, but it's just an interesting statistic to come out with that. So when people start to say to me, and I get it all the time, but David, what about the interest rates? I mean, isn't that going to change things? Yeah, to in some sectors, but when we're talking about this type of product around where we are sitting right now in Coral Gables, no, not really.
I completely agree with you, especially for the client that you're serving, which is let's talk about that 3, 5, and even higher million price point. The mortgage is really it becomes less of a factor. Mm-hmm. It really becomes less of a factor. What's happening with that client is not a concern of whether or not they can get a loan. If you think of the customer journey, right, of that level of client, they come to you looking for a home, knowing that they're going to secure the funds, whether they have it in their account or they're going to secure the financing. Contrast that with somebody who's entry level, right? They go talk to a mortgage person first, right? Figure out what they qualify for and then go buy a home.
Totally different buyer.
Completely different.
Yeah, and I definitely see that, because at the end of the day, these guys their decision of whether they should buy has nothing to do with whether or not they're going to get a mortgage. It's all to do with whether or not it's the right time to buy. And so they reflect on the mortgage rate more on the psychology of the market and what is affecting the psychology of the market. Yeah. There is one sector I'm curious to know about, which is what we've seen a lot of happen in the last couple of years, and that has a lot to do with the rental market in places like Brickell and downtown and Edgewater, where a lot of buyers have come in and bought properties to purchase with very high returns on their investment to rent it out. But obviously with interest rates moving, are you seeing any shift there at all?
Somewhat. As you bring up the rental market, I always love to talk about this parabolic movement that we've seen since 1988. That's what rents look like.
Wow. That's it. Okay, we're going to flash this up on the screen. That is insane. That is immediate. Okay, so national numbers. Yep. And again, I know Miami's is its own animal here. Yep. But that is that's a crazy curve. If that was a stock, you'd be like, oh my, that's like looking at Amazon stock.
Right.
It's really wild. So extreme. Now, when I look at something like this, and obviously at no point does it really ever drop.
That's the most astonishing thing. Look at 2008, right? It did drop off.
So flashing this up on the screen, it dips a little bit, but it doesn't dip a lot. And exponentially, it just keeps going. Now, what is it? And again, I look at the rental rates, and again, this is up to like just under 2,000,
so this is very cookie cutter. The data of this is the census. It's the U.S. Census, right? So, it's really a more mainstream client. But I think this is indicative of what rents look like.
And this is probably a reflection of just population growth. I'm got to assume that this increase in rents is because you've got more people and less product. That's the only way it can happen.
It's definitely a factor. Or the pace of the product increase is not keeping up with the pace of the population growth. Yeah. Right. That's where the disconnection is. So going back to whether or not rates are affecting. Here's another story. It's not a story that you heard in my report, but in 2013, I bought a couple of condos in the Edgewater district.
Okay.
Middle end. So we're talking $500,000 valuations. Okay. At the time, when I buy a rental property, I prefer to put enough down to make it break even, right? Yep. I don't want to be negative cash flow. Mm-hmm. At that time, it was about 30% that I had to put down. I recently did that again in the Edgewater district and I only had to put down 10%, right? So that gives you an idea of how rents have increased, outpacing the cost of ownership, right? So, it's a significantly less capital requirement to get to a break-even situation.
Now, the rental numbers went up a lot. And again, much like the appreciation of the values of properties that we've seen over the last 2 years, it begs the question, again, is that sustainable? When you get that level of increase of rents, and then, of course, then the value of properties works in association to what the rental income is, because people are buying based off the fact of how much they can rent it for.
Yeah.
We've seen historically, and again, this is, the data that I have with Condo Geeks, which is, again, the software that we use to analyze long-term patterns of behavior within the condo market by neighborhood and by building. We've seen some oscillations. We've seen corrections in 8, we've seen it in 15, we've seen it in 19. And obviously then each time it's kind of moved up a little bit. Obviously I know you're a mortgage broker, not a real estate broker, but I guess the question is begged whether or not we're going to see any corrections in the rental market, because any corrections in that market will create a change in values of those properties.
Yeah, without question, right? And now we really have to focus the conversation on South Florida, because the population dynamics here are completely different to what's going on in the rest of the country.
Yeah.
So, perhaps you have a lot of out-of-state listeners to this podcast, so it's worthwhile mentioning that median income is very disconnected with the cost of home ownership or cost of living in Miami-Dade County.
Yep.
What's driven up these rents is really, a type of client that has a lifestyle where the pandemic has led them to realize that they're able to work remotely, at least for most of the year.
Yep.
And there's a lot going on of moving of state for the purposes of tax domicile, right? So if you spend sufficient time of the year in Florida, you can domicile here and not pay state income tax, and yet keep your higher paying job from New York or California, for example. So I think that has had a lot to do with the spike in rents, especially in the first 3 or 4 months of 2022, where we saw a lot of New Yorkers coming in, and they're comparing the product they can get here with the product that they were getting in Manhattan, and they were more than willing to buy South Florida standards.
And they had the money to do it.
Exactly. By South Florida standards, they were more than willing to overpay. And so that really, really drove things up.
And that then, obviously, that's why out in the press, people say, look, I can't afford to live in Miami anymore. I can't afford to live in Brickell. I've got to move out. And there's a whole lot of press, and there was stuff that we even saw that we did for the CNBC News when they touched on that subject. Now, as that moves forward, the question, obviously, is the how much money people are putting into rent and whether they can keep doing that for a long period of time, or whether there's a reckoning where they say, you know what, I can't keep doing that indefinitely.
Yeah.
And I think one of the bits of data that you had brought up and shown on your report in September was the amount of money that's being spent on lifestyle and on mortgages and rents is now very much out of whack to what it was before.
Yeah, it's actually, it was the highest, I don't have that slide with me, but it was the highest it's been in that time period, right? So when you look up to what the years leading up to the crash, I want to say it was at 24 point something %, and now it's at 25.1% or whatever it was. So it's right up there, right?
Yeah.
It's like a double top. That's I don't want to say that is concerning, but I do, we have to recognize that that is a major shift. And
absolutely got to pay attention to that. Yeah. And I think all of this data and all this information coming round into the question, which is, what should sellers do right now? Should sellers get out? And I know that in some cases, not necessarily long-term. If you're a long-term holder of real estate and you say, look, I've got a 10-year horizon, then no, don't do that. Just stay in it.
Right.
But the reality is that there's still a lot of people who buy into, and if I look at the general life cycle, and let's get specific, getting into the condo market, and then we'll go into the housing market.
Yep.
There are condo markets that we would say to you, if they are heavily rental based, there's a lot of investors and what I call speculators involved in that, which are not long-term investors. They're the short-term window, 2 or 3 years and sometimes even less. Those will have some level of correction as inventory grows. And I think that's why when we start to look at all these factors right now, it's not as beautifully rosy as it was a year ago, where we can see massive increases of values of properties. We're seeing more inventory coming in. We're seeing some slowing behavior. We're seeing some negative press. As a result, that's why everyone asks us the question, what the hell's going on? Because they see what's out there in the media and they're feeling it. Right. So it makes them think that change is coming. And with that in mind, I am seeing a slowdown in pending deals. Pending deals are dropping in sectors of the market. I am seeing inventory increasing. I am seeing those last hurrah of flippers trying to get out the door because they realize that if they're going to make money and a good amount of money, now is the time to try to do it. And at the same time, there's a lot of other factors within the condo market that we're looking at, such as the older condos and assessments and mid-level product that's now getting a little bit more dated, that looks a little bit more tired. And like every product that you have after a while, your car that looked great when it was brand new, now it's 3 or 4 years old, you're kind of ready to trade it in. And then so is everyone else. They're trading their car in at the same time. So there's that element. So when we get into the condo market, my advice as a broker, drawing from your advice as a mortgage broker, is that there is definitely some sectors of the condo market that you've got to be aware of. I was actually surprised that when I started to run it for the beach, the Miami Beach area, and some of the other sectors, like in Sunny Isles, which I thought I would start to see inventory grow quite quickly. I'm seeing stuff still. I've seen inventory grow a little bit, and I've seen pendings drop a little bit, but not as much in other areas. And that I can speculate maybe something to do with the South American influence now coming into play.
Yeah, it's interesting how that works, right? Because it's always so geopolitically driven. I remember when Brazilians coming to Miami were very much in vogue. And a lot of them back in, I might get my dates mixed up a year or two off, but I want to say I was processing loans in 2015 for pre-construction product where the deposits were made a couple of years before that when the Brazilian real was at an exchange rate of 1 to 2.
It was 12, 13, 14, 15. I'm married to a Brazilian, so I know exactly what happened. And you're right. When Juma came into power, I saw everyone coming in, and then all of a sudden the pre-construction, that what I call the not the last round but the round before of pre-construction condos in Brickell, which was things like the SLS Lux, Brickell Heights, Bond, 1010, all these buildings, and then up into the Sunny Isles where I saw Jade Signature, and even I remember before like Jade Beach, Jade Ocean. Remember those back in the after 2010, 2011. Yeah. It was all, and when Porsche Tower was first being sold, it was all, I just remember a flurry of Brazilian buyers coming in. And you're right, the exchange rate was like 2 to 1.
A lot of those made the decision when the real was like that. I had a client who heads up the Goldman Sachs office for Miami, and they investment banking on the investment banking side. And so he would tell me, and he's happened to be Brazilian. He would tell me what was going on in Brazil.
I know who you're talking about. I know him too.
Okay, maybe he's your client too. So he was telling me like, look, things are just overheating over there, and sure enough, things fell. And when things started to fall, the exchange rate started taking it on the chin. And suddenly we had, it was interesting, we had clients who made a decision to purchase into something where the real was 2 to 1 to the dollar. Now they were having to make the decision was 4 to 1. So there was 100% devaluation of their exchange rate. So a huge shift in the cost of acquiring the asset. So anyway, fast forward that to today, I guess what's the hot topic now is Colombia. Colombia just went through an election. Some people are concerned, some people are not. And whenever there's concern, we see a push from that particular country here to Miami.
We saw Colombia and Chile as well, actually. Chile is an interesting one because they just had obviously a big political kind of movement. And Brazil is about to get its election coming out. It's in rounds now, and it's a question whether it's going to be Bolsonaro or Lula. I'm not going to get into the political conversation. I'm not a politician. I have zero interest in going into that arena. But I do know that a lot of people are very nervous of the outcome. And so we're starting to see movement, even though the exchange rate is, 6 to 1? I think it's about 6 to 1
it's in
right
the sixes now.
Yeah, it's pretty horrible relative to what it was before. But I guess the outcome in their minds of the results of the election is more horrible than the exchange rate. So we are seeing movement. I'm seeing movement with actually when I speak to some of the pre-construction sales teams up in parts of the city, and some of the sales directors, one particular I know who's Brazilian, would tell me, David, I've got a ton of Brazilian clients now engaging with me and who have bought some very expensive real estate in that project. And it makes me wonder if it's like ding, ding, round 2. Here they come again.
Yeah. And contrast, layer that on top of that, the fact that a lot of the new construction product in the areas you just mentioned is all higher end, right? So
it's all high end.
It's all higher end. So it's almost geared towards capturing a client who's trying to distribute wealth, right? Yeah. Let's call it wealth distribution of their own.
You're much more PC than me.
Capital flight. So yeah, I mean, to your point, it's interesting, and the next few quarters are going to be very telling with regards to how that goes.
For sure. I mean, I'll give you an example. When we talk about the new construction, and I've done a study on this, I'm going to give myself a quick plug here. If you want to look for the best new construction condos in Miami, I have an article or a full report on this, and I actually do the independent analysis. I talk about the good and the bad of the key 5 new luxury projects that are coming out, and there's more than 5, but I cover Vita in Coconut Grove, St. Regis in Brickell, 5 Park on Miami Beach, Paragon Miami Beach, and Bentley and St. Regis again up in Sunny Isles. And those are the big boy players that are coming out of the ground. There's some more. There's like there's Cipriani, and there's Waldorf Astoria, and there's Aston Martin's going to come out of the ground next year, and Baccarat, and there's a whole bunch of them. Yep. But the fundamental is that none of these buildings are selling below $1,000 a square foot. Yeah. None of them. Yeah. And most of them are all at $2,000 a square foot and up. And a number of them are at prices that are record levels for the neighborhood even to begin with. Yeah. So, St. Regis in Brickell is coming in at $1 per square foot, never seen before in that market. Yeah. It's also a product that hasn't been seen like that since the Four Seasons. But still, that's not speculative or quick investor money that comes in. Those people are looking to buy. But it's interesting to see how that crowd plays out, because that's hundreds and hundreds of properties.
Exactly, and it's and you have to wonder, will the demand be there to accommodate to absorb that supply? Remains to be seen. But to your point, it is wealth reallocation. Yeah. It's not speculation, right?
And that wealth relocation is an extension of the wealth relocation that we've seen from the Northeast. California, New York. I mean, when Ken Griffin announced his Citadel move, everyone was like, how are we going to live in a city where all these guys who are making $20-30 million a year are coming into my town and they're buying up houses? Yeah. It's like Palo Alto, or it's like second Palo Alto.
Yeah, absolutely.
So that then... I guess we could probably segue into the housing market from that. That could work. With the housing market, and again, inventory, and we'll flash up on the screen, and if you want more data specifically, this is accompanied with a blog. So you can read the blog, you'll see all the screens, and you'll be able to kind of pour all over all the data that you'll get. But we also would like to touch on, or I'd like to touch on with you, the housing market. Because inventory in the housing market is low. It's still low. It's rising, but it's still low. And a statistic that you'd come out with was that in 2019, our inventory is still 42% lower. I think I'm saying this right.
You're correct.
42% lower. See, I do my research.
Yep.
42% lower than it was the same week in 2019.
Correct. Yeah.
That's pretty substantial, because 2019 wasn't a horrible year.
No, it was definitely a year that felt slower than some. But obviously, of course, 2020 was way quicker once people got a handle on the pandemic. And
by June, I think the first 5 months was dead.
So 2019 was not a stellar year, but it was not a bad year by any means, right? And what the slide is showing is that inventory is still down 42% compared to what we had back then.
Yeah, and when we go into, and I'll give you a reflection on that with the local markets, our inventory within local markets, when we were studying it on Q2 and into Q3, when we brought out a big report that we titled rather, clickbait as crash correction or continued growth. Don't hate me for it. I'm just trying to get some attention here. The reality of it was that we had very low inventory, and in some sectors of the market, like 2.3, 2.5 months of inventory, 3 months of inventory. This is a level where 9 or 10 would have been good. It would have been balanced, and it was nowhere even near that. Yep. Now moving on, and we're in September, towards the end of September, inventory is growing within sectors. I'll just let you guys know, as we stand in September, and I got this data this morning, I was looking at how inventory is growing, and pending deals have dropped in the market. New listings are up. If I looked in Coral Gables, which is where we sit right now, there's 48 new listings within the market. A number of them are properties that were relisted. There was a smattering of them that were actually houses that were renovated and they brought back into the market to try and flip them out. But then there was obviously a good amount of other product. But the quality of the product is not... It's not stellar product. It's not like super amazing walk in, this is an incredible house. We've got a house we just put on the market today, and the phone's been going off the hook because it's a newer house. Mm-hmm. So newer houses still very much in dry supply. Inventory is increasing, but it'll need to increase a lot in order for the conversation to be in a position where we're going to see a drop in values.
I would agree with that. I have to agree with that. It's very difficult to see a meaningful correction right now. I'm not opposed to the idea that the market could chop sideways for some time. I'm not opposed to the idea that the market, could see a very small level of depreciation, but 10% would surprise me. 20% is difficult to see. 30% almost impossible. You're getting to 2008 activity at that point, and the dynamics, the state of the housing market, the quality of the mortgages that we've underwritten over the last decade are vastly different.
It's mathematically impossible is what it is. That's the way I look at this. I do the math. Like the calculation of supply and demand is the gravity of the economics we're dealing with. And there is no fighting it. You cannot, in any model, and it's never happened, where if I've got 10 apples and I've got 100 people who want those apples, that the value of those apples is going to go down. It's not possible. It doesn't happen. It's simple. Yep. It's just obvious. Just simply look at the numbers, do the math. Spend less time looking at the news and reading articles and imagining, apocalyptic style, situations, and look at the figures more accurately, and it should give you a little bit more peace of mind. Yep. Now, that doesn't mean that there aren't people who are shooting for the moon for very high numbers that are not in line with the true market figures, and they're not going to achieve those.
Without question. This is one of the things I touched on in the September report, right?
Yeah.
I think this is a market where sellers are coming to their senses.
Yes.
Before they were unreasonable, but buyer desperation met that asking price, and the buyers hit the asking price. Now it's time to come to our senses, and the valuations that some of them are asking for are outrageous, and buyers are not having it.
Yeah, the question of should sellers get out. I had a conversation with a guy a few days ago, and he had a house that he brought onto the market for. It was I'm not going to give the numbers, but it was I will give the numbers. Screw it. It was like they bought it for $2.5 million, and they brought it back into the market for $3.5 million.
In how much time?
In 9 months. Now that was in December last year is when they closed on it. Okay. So I'm looking at this when the market was gangbusters in December last year. It was as hot as it could be, and now that then the market started to cool off into Q2 of this year, 2022, and then you've got a guy who's trying to slap on nearly 50% on value. Of course, that's not going to sell. That doesn't mean the market's crashing because that guy doesn't sell his house. It just means that guy was just unrealistic to begin with. Yep. And he shouldn't have listed that in the first place. Yep. But if you price according it to the comps of what you've got and what's actually selling, and you then work backwards from that and say, okay, where's the best that I can do? And you put it beautifully. The asking price is the ceiling of what you can get, not the starting point. Yep. Which I think is as good as you could say it. So the days of people bringing stuff to the market at $3 million, and then you've got 50 people deep in an open house, all bidding each other at or above asking. It's not going to happen. Yeah,
exactly. And I think one of the things that's contributing to the slowdown in sales velocity is something that was put very eloquently by a realtor that I know, who said that sellers are looking 6 months back and buyers are looking 6 months forward. Right, and so you've got this pretty wide bid-ask spread between what a buyer's willing to pay right now, what a seller wants to sell for. It feels like, I don't have data on this, but it feels like it's a pretty wide bid-ask spread right now, and so that's contributing to the slowdown in sales, and over time that will correct itself, that'll narrow. But it's just something that. We need
I think that's a very good, and again, psychology is everything. That's why I'm a big Ray Dalio follower, because I lean into the human psychology of everything, and that defines where we're going to move. But that actually, when you think of it like that, and we'll say it again, I'm just going to repeat it. So buyers are looking 6 months forward to where markets will, in their mind, soften.
Correct.
And sellers are looking 6 months back when things were amazing and rosy and everyone was just throwing money at you. Yeah. And if you look at that spread, it's a much bigger chasm than it normally is.
Yeah. And so you've got the standoff between buyers and sellers, and that's not helping sales velocity. But again, that'll correct over time.
Yeah. Well, I think that That covers a lot of what we've been talking about. We're going to bring up more data into the article so you can read up on it, you can understand it. I think that the key is understanding the behavior right now and reading the information, and rather just reading the media and taking on board what's going on there. Yeah. It's not all gloom and doom, but I think there's definitely things to pay attention to. You've got to be smart about this. You cannot think that, like we had before, people would just throw money into any piece of real estate and it's going to give you a massive rate of return. Yep. You've got to be clever. You've got to run the numbers, pay attention to the details, and have someone who actually knows their figures and can guide you accordingly.
Yep.
Paulo, thank you so much.
Thank you.
Really appreciate it.
Absolutely.
And as always, stay tuned for another episode of the Better Decisions podcast.